Micron and SK Hynix have surged. AI memory demand still looks strong, and both stocks can still appear cheap on earnings. That sounds like an opportunity. But memory stocks often show their lowest P/E ratios when profits are closest to a cyclical peak. So are AI memory stocks genuinely undervalued? Or are investors using peak earnings to justify peak prices? Here is my view. HBM demand is real. AI memory is structurally stronger because advanced accelerators need more bandwidth and more stacked memory. But memory is still a supply business. Higher prices lift margins. Higher margins attract capital spending. And new supply can normalize earnings quickly. That is why I would value Micron, SK Hynix, and Samsung using normalized earnings, not peak cycle EPS. The right question is whether today's prices, margins, and earnings can survive the next supply response. This video is for education only. It is not financial advice. Let's break it down in simple English. AI accelerators need data delivered extremely quickly. HBM places stacked memory close to the processor, creating much more bandwidth than conventional memory. That is why NVIDIA systems pull demand through the memory chain. But Micron and SK Hynix also sell conventional DRAM and NAND. So HBM can stay strong while the traditional cycle still matters. Micron reported fiscal third quarter revenue of $41.46 billion, GAAP gross margin near 85%, and diluted EPS of $24.67. It guided to about $50 billion of next quarter revenue, an 86% gross margin, and GAAP EPS near $30.73. SK Hynix reported first quarter revenue of 52.6 trillion won, operating profit of 37.6 trillion won, and a 72% operating margin. Samsung's memory business also reported record revenue and operating profit and began HBM4 sales. The boom is real, and producers now have a strong reason to add capacity. Imagine a stock trades at $100 and earns $5 per share. Its P/E is 20. Then memory prices rise. EPS jumps to $12, while the stock rises to 120. The P/E falls to 10. Now new supply arrives and EPS falls to $6. At the same stock price, the P/E returns to 20. The cheap valuation disappeared because earnings were temporary. Trailing P/E uses past earnings. Forward P/E uses forecasts. Normalized P/E estimates sustainable earnings after prices and margins cool. For memory stocks, that may be the most useful number. Micron has strong HBM momentum and broad exposure to conventional DRAM, NAND, mobile, client, automotive, and storage markets. SK Hynix has deeper exposure to premium AI memory, server DRAM, and enterprise SSDs. Samsung is the competitive wildcard because better HBM execution and more conventional memory supply could weaken pricing power. At Micron's July 17th closing price of about $848.95, the stock traded at roughly 19.2 times trailing earnings. But forward P/E estimates vary sharply because analysts are using very different assumptions about how long today's memory prices and margins can last. So instead of treating one forward multiple as definitive, I will build my own normalized earnings cases. For SK Hynix, I will use the market value of its sole listed shares rather than the newly listed USADR, which may trade at a different valuation. There is already an early sign of normalization inside Micron's own outlook. Management said its fourth quarter guidance assumes a meaningful moderation in the rate of price increases. At the same time, Micron expects fiscal 2027 quarterly capital spending to run above its fourth quarter level. That does not mean a downturn is imminent, but it captures the central tension. Pricing is still strong, while the industry is preparing more capacity. These are MarketMind AI scenario estimates. They are not company guidance, analyst consensus, or price targets. The purpose is not to predict one exact EPS number. It is to test how sensitive today's valuation is to lower revenue and lower margins. For Micron, I will use a reference price of $848.95 and approximately 1.15 billion diluted shares. Bull case. Revenue reaches $200 billion. A 68% normalized net margin produces $136 billion of net income, EPS near $118, and an implied P/E of about 7.2 times. Base case. Revenue is $160 billion. A 58% normalized net margin produces $92.8 billion of net income, EPS near $80.70, and an implied P/E of about 10.5 times. Bear case. Revenue falls to $125 billion. A 42% normalized net margin produces $52.5 billion of net income, EPS near $45.70, and an implied P/E of about 18.6 times. For SK Hynix, I will use a reference market capitalization of about 1,252 trillion as of July 20th. This figure must be refreshed before publication. Do not use the first quarter net margin as a simple annual run rate. Bull case. Revenue reaches 220 trillion. A 60% normalized net margin produces 132 trillion of net income and an implied P/E of about 9.5 times. Base case. Revenue is 190 trillion. A 47% normalized net margin produces about 89 trillion of net income and an implied P/E of about 14.1 times. Bear case. Revenue is 150 trillion. A 30% normalized net margin produces 45 trillion of net income and an implied P/E of about 27.8 times. The same stock can look cheap under peak earnings and much less cheap under normalized earnings. My base case is gradual normalization, not an immediate collapse. HBM remains structurally strong, but conventional memory pricing and exceptional margins become harder to sustain as investment and supply respond. 6 things matter. HBM pricing, conventional DRAM and NAND pricing, inventory, gross margins, capital spending, and hyperscaler AI capex. The bull case strengthens if HBM stays tight, inventory stays controlled, and margins hold. The bear case strengthens if inventory rises, Samsung and new fabs add supply faster than demand, or big tech slows AI spending growth. AI memory demand is real, and this cycle may remain stronger for longer than older memory cycles. But a low P/E alone does not prove Micron or SK Hynix is cheap. The opportunity depends on how much of today's earnings survives when supply catches up. My base case is gradual normalization, not an immediate collapse. HBM remains structurally strong, but conventional memory pricing and exceptional margins become harder to sustain as investment and supply respond. Current earnings may stay high for a while, but investors should not assume peak margins last forever. Comment cheap if you believe AI memory earnings can stay elevated. Comment peak if you think the next supply cycle will pressure profits. This video is for education only. It is not financial advice. We decode the markets. You make smarter decisions. I'm MarketMind AI. See you next time.